It is 9:00. Pepe Finn. Paul Hamble.
Here.
Sharif Mansuri.
Here.
Jody Patterson. Online. Can you hit the view all button so they can see the panelists, please? Thank you. Captain Aaron Schaefer.
Here.
Anthony Waskaris.
Here.
Milton Wilkins.
I am here.
Greg Kramer is online. He is in for Henrietta. Henrietta has left the county, so Greg is stepping in. He's our Deputy Director of Fiscal Management. And Matt Livesey was not able to join us.
Okay,
Thank you.
fine. Pepe told us ahead of time that he has a conflict, he is out of town and would not be able to participate by, I want to say Zoom, by WebEx. So I need to have a motion that we accept Pepe's explanation for her absence.
So move.
Second.
Is that Paul and Aaron? Okay, all those in favor? Aye?
Aye.
Aye. Any opposed? Okay, done. That's first item on the agenda, or first two. Approval of the minutes of the June 17th meeting. Does anyone have any questions or suggestions concerning those minutes? May I have a motion to approve? Motion. Tony makes a motion. May I have a second? Paul seconded. All right, Paul, thank you. I appreciate your second. All those in favor? Aye. Any opposed? Don't be timid, Paul. We want to hear from you. All right, next is the request for benefits. We have 12 civilian requests and 3 police requests. May I have any comments or questions concerning these civilian requests?
None.
Becky?
No, sir.
No controversy, no issues or
Yes, sir.
anything necessary. Okay, may I have a motion to approve? So moved. Paul made a motion to approve. Aaron seconded.
Second.
The motion to approve for the civilian request. All in favor?
Aye.
Any opposed? None. All right, we have 3, I believe, police requests.
Make a motion to approve.
I'll second that motion. Got it. All in favor?
Aye.
Any opposed? Okay, applications unfortunately for death benefits. Thankfully, a relatively small number, but nevertheless, civilian requests.
Move it.
Second.
Paul and Aaron, all those in favor?
Aye.
Any opposed? And police requests?
None.
None. It's very good. All righty, that moves the agenda directly into the ACG discussion, of which there are at least 2 parts, the monthly performance report, and then we return to the whether or not we add a manager and the nature of the manager to the large cap international value allocation. Want to take Phineas?
Yes, thanks, Mel. And yes, and that's exactly what we'll cover today. You have the book in front of you. First, we'll just do, it's been, pretty busy year from the market standpoint, right? We have our performance through June 30th, so first half of the calendar year. So just hit on a little bit of the market, but then certainly give an update on our performance, where we stand through June 30th. And then, yeah, as Milt said, we'll talk about, we've been talking about this for a little bit now, within our international portfolio. Remember on the developed side, we have Silchester on value, WCM, large growth, William Blair, smaller growth. And so there's been some talk about complementing Silchester with another manager. So we'll get to that discussion in a little bit. But first, why don't we start on the first tab? You can just go to page 5, market update. And ultimately, really kind of what has driven this year has been starting off with just the uncertainty around the tariff announcements that came Liberation Day, April 2nd, and then really kind of strong, a lot of uncertainty at first, but then really kind of strong market rebound post that. And I'll just even kind of show you, this is that graph on the right hand side of the page. That's the S&P 500. So this is just its price level, where it was as we kind of started this year, going into March, particularly April, big drawdown, about 19%. And then since then, really kind of strong rebound, really starting in May, up over 25%. So actually through the first 6 months of the year, the S&P's up 6%. You've gone on vacation, you just came back, you've been like, oh, it's kind of ho-hum. Certainly it's been a lot of activity within that. But you can kind of see, looking back to the left-hand side of the page, we have all the major equity fixed income indices where we invest. You can see the dark blue lines, what happened in June, really kind of mostly positive results throughout June, pretty much across the board, both stocks and bonds. Then you can see this lighter blue year to date. So that's the first 6 months of 25. And so certainly really strong performance, particularly in the international markets. I mean, this is something we've talked quite a bit about over the past, and I'll show you, you can kind of see it on the next page, but, over the last several years, markets really been driven by U.S. large cap outperformance. And we've seen international really kind of rebound here. And so what you're looking at, kind of showed you this schematic before, all the major areas where we're invested. Year to date, the light blue is the performance through the first 6 months of the year. And then if we look back, all right, what are the, as of the end of June 30th, the last 10 years annualized, where are the returns? So again, what you see, this is in order of what's performed the best so far this year. You can see international, both developed markets, EM, up 15 to 20%. U.S. large cap positive. Really the one area that has struggled so far this year to date has been U.S. small caps, down about 2%. But of course, if you look longer term, last 10 years, certainly U.S. large caps have continued to really be the strong outperformer. Everything else is positive, but not quite to the bit of U.S. large cap markets. So kind of not surprising. I think we all know that. I put page 7 in here just as, this is a good reminder of how volatile equities can be. Just kind of, partly how tough it can be to time the markets over different periods. So what you're looking at, this is the path of the S&P 500 the last 5.5 years. So going back to 2020. And so beginning of 2020, so obviously we knew, the COVID pandemic kind of early on, that big drop. As the Fed increased stimulus, consumers spent, you can see we had a 1.5 years of really strong growth, up over 100%. This kind of started 22. This is when the Fed started raising interest rates. If we all remember, 2022, certainly a tough time in the markets for our portfolio. Certainly a strong rebound in 23 and 24, and then that V shape at the top. That's just this year in 25. So again, I think it's always just, a good reminder as, not just all the way to the right, this V we experienced just now, but even, I've drawn these nice diagonal lines, but obviously it's bumpy along the way.
I think the other thing to comment when you're looking at that, the steepness of the increase in the S&P 500 over the last several years, we really use your strategic allocation and your cash needs to take risk off the table. So that period where you see the S&P going up dramatically, if we put the non-US markets and emerging markets on there, they certainly wouldn't have been as steep, but we were taking money from large cap every month to pay benefits. And that's taking risk off the table to get back to your strategic target allocation. So we're not trying to be tactical. We're trying to maintain that strategic risk posture that you established as a reasonable way to have the highest probability of achieving your required return over time.
And so just, in summary, it's certainly been a volatile year in the marketplace, particularly on the equity side. But ultimately, the S&P 500 U.S. large cap is positive for the first half of the year. U.S. small cap's negative. The really strongest performers in the first half of the year are international markets, which we've seen a really strong rebound in. So with that, why don't we flip to our portfolio? So page 10. So this is how we sit from an allocation perspective. As of the end of June 30th, you can see we're about just over $920 million in the portfolio. Comparing our actual allocation versus our target allocation. As the board knows, we changed our target allocation up a few months ago. So you can see where we sit over, underweight in our portfolio. And really kind of the largest overweight we have currently was within real estate. Our target is now 10. If you remember, it was 15. We lowered that down to 10, and it just takes some time to move real estate capital. We have about $25 million that we've requested cumulatively from both Reef and Heitman that will be coming back Reef, we should be getting some in the next few weeks. Heitman is on a quarterly basis, so we'll start getting some of that money back in the fall. But we'll be able to receive that about 25%, which is really, or 25 million, which is about all of that overweight, and then kind of
The
redeploy.
25 million just,
It won't come at once.
Well,
that's the two of them.
that's the two of them combined.
It's $14 million, I think you told me.
14's from Reef and 11 is from Heitman.
And the 14 comes in first.
Yeah, it's not, it's still to be determined how much we'll get per time, but they pay out on a quarterly basis. Heitman has a quarterly notice period, so that's why they're not.
Still an execute, so it's
I'm
just
trying to get a feeling for it. The dollar amount we would expect to be distributed back to us this month, to be reinvested this month.
it will be small.
Yeah, it won't be the full 14 from Reef.
Well,
It'll be a portion of that, and they haven't been able to, they're receiving all their redemption requests, and it'll give us a number when they can, but we don't know yet.
and Heitman isn't until.
Heitman's first payment will be back in October. So, but that money will certainly then be, as we get that back, will bring us down to our target within real
Why don't
estate.
you explain to the board again why it's October as opposed to July,
So,
just so we understand.
yeah, so
the
pretty much
mechanics.
all these real estate managers have a quarterly redemption, so you can't get out every month. They pay, usually it's the month after quarter end, their redemptions. The difference with Reef and Heitman, Heitman has an additional quarter notification period. So basically you almost have to wait an extra quarter to get that out.
And then the other factor is because most institutional portfolios were overweight to real estate following 2022, when equities and fixed income came down.
Mhm.
There was a lot of redemption activity, like investors like yourselves putting in redemptions to get money back from their real estate funds. Well, real estate funds aren't liquid. They own buildings, office buildings, apartment buildings. They just can't sell those. So they put in place what's called an exit queue that limits the amount that can come out quarterly based on liquidity that they have. Most of those queues have abated. They're getting down to almost nothing, so money will be coming back sooner. The other thing that is happening that impacts the percentage allocation as equity and fixed income goes up, real estate, it's starting to go up as well. We've seen a bottoming in the real estate markets, but that's changing the denominator effect as well.
So for us to get money, for us to have received money in July from Heitman, we would have had to give Heitman notice March 30th.
Before March 30th, yeah.
Before most of them.
On or before March 30th,
Right.
to get money in July, because they have a
Correct.
full 90-day lead time.
Right.
Okay.
Yeah.
So I always say these are open-ended real estate funds
Until
until
they're
they're
not.
not.
Until they're not, right?
I'm just looking at the over under. Can you remind me how the rebalancing works when we move away from target allocation? Is it a discussion here before we rebalance? Is it automatic? Does it have certain, how does that rebalancing work?
So within our IPS, for all the, you can see the ranges here in the gray bars for the big equity
Yep.
fixed real assets, but then with all the other ones, we do have ranges, kind of plus or minus 5%. And so really kind of,
And I think it's plus or minus 20% from the target. So if the target,
It's plus or minus 20% from the target with a minimum of 2 percentage points.
right, so if the target's 20%, 20% would be 4%, right?
4%.
Right, so, but the primary rebalancing function, because this is a pension fund that needs cash every month, is your operating needs.
Yeah.
Okay.
And we look to what is overweight. So like I said, for the last, I'd say 5 to 7 years, you've taken over 150 million out of your large cap portfolio to pay benefits. Now, more recently, there might be some other areas, but it's also Sharik liquidity. So, if we looked at it today, we'd say, well, it should come from real estate. Well, we can't get it from real estate. So it's,
Yeah, I mean, just put some numbers on that. So we typically pull out somewhere between, 2-3 million a month for benefit payments. So you put on a year, that's about, 3-4% of our portfolio, we get pulled out. And so that kind of, a lot of that will then, as Jay said, will come from, rebalancing and pulling from what's overweight. So our performance on 11. Yes, these are performance again, net of manager fees. So as I mentioned, 921 million in the portfolio as of June 30th. You can see overall the month of June was positive. We were up about 3.3%. First thing I'll point out is you kind of look across the board and pretty strong returns across. This is something particularly kind of in the 3-5 year. If you remember, the last few months we've been meeting was certainly below our actuarial target, but we've certainly seen some of that rebound. So for instance, the last 3 months, which is the second quarter of 25, up about 8%. So again, this kind of, this is where a lot of that volatility was, and certainly that strong rebound there. We're just behind our policy index for the quarter. But you can see actually that 3 months higher than year to date, right? Just kind of that speaks a little bit to the volatility we have. Tough first quarter, strong rebound here in the second quarter.
Is this the first month ever that we exceeded 900 million? That we even reached 900 million?
I don't think so. No.
Well, it's up 3%. Of course, it's statistical. If this isn't the first month, it had to be within the last.
Well, no, I think.
No, I think back in 21.
21, yeah.
I remember being over 9.
Was it?
Yeah, it was close to it.
Okay, more recently, has it?
No.
Oh,
No, since the pullback
we
in
took that
22.
to that in 2022. Is that
Right.
Right.
That's a big drawdown.
Yeah.
Okay. But more recently, was it last month or this month, we're back over 900?
Yeah, but it's close to an all-time high.
Hmm.
Back to where we were from an asset.
Just anecdotally.
Yeah.
Anecdotally, what was it all time ago?
Probably when we started. I don't know.
I mean,
Let me rephrase that. In the last 10 years, what was the all time low? 22? How low did we get?
we're down in.
We were below
700.
8.
Yeah.
Yeah, we were below 800.
What about 2008?
Well, so a lot of money's gone in since 2008. Well, this on page 15, we show this
You don't have a historical
estimated
performance
asset liability
schedule?
scorecard. So 2010, the assets are I can't just say.
You don't.
The assets of the blue line.
It was about 400 million.
So in the last 10. Yeah, so in 20, kind of at that kind of bottom I was talking about with COVID, that was probably closer to 6, less than 7. And then in 22, dropped below 8.
Perhaps you
So-
can run an inflow, outflow performance by year kind of a thing next time.
Yeah, so in our
In the
quarterly
quarter
book,
report.
we have, we bring every quarter will be in next month's meeting. So we have, actually, as you look out over, kind of the various different years and different time periods, what the starting value was, what all the inflows were, what investments made, what we paid out in distribution. So we report that on a quarterly basis.
Sorry, sidetracking.
No, good question.
I think it might be useful just to put that in there monthly to answer or preclude questions. You have the number, you have the data, so let's just put it in there monthly
Okay, yeah, so I think it's
rather than quarterly.
certainly relevant. So yeah, we can have that. And then just what I want to highlight, so on performance, you can see pretty strong numbers again. The last year, we're up 10.5%. 3 years again, 9.4, 5 years, 8.5%, 10 years, 7.3. I do want to point out in particularly the last, even year to date, I'll look at in kind of last 5 years, you can see some underperformance versus our strategic policy index. Yeah, our strategic policy index is our target asset allocation, which remember was a little bit different pre-April, but how we performed. And actually a lot of this coming from, it talked about how strong US large cap has been over the last really decade. Our underweight relative to our policy index of what we have in large cap, particularly large versus small ratio. And you can see, for instance, if you look down the year-to-date column, so year-to-date, the last 6 months, You can see we're up 7.5%, 90 basis points behind our policy. Where that underperformance comes, if you look at, kind of the three, I should say, four main areas we invest. First off, that US equity line, you can see within US equities, we're up 3.9. Russell 3000, which is market cap weighted US large and small cap, up 5.7. So that's about negative 1.8% relative performance. I'll come back to this in a sec, but looking down at non-US equity, you can see that column there. Again, I mentioned how strong that's been. We're up over 18.7%. So, about 80 basis points outperformance. So that's international equity, go down to fixed income. Fixed income continue higher yields, provide us higher return. We're getting 4.5% so far this year, some outperformance. And real assets, you can see, starting to be positive again. This number is actually just through March, so we would expect this to go up a little bit. But some outperformance in real estate. So really that underperformance coming from the US equity portion of our portfolio. And it's more so not necessarily our managers that have underperformed, but other allocation difference of large and small.
So let me understand what you're saying. So if I go to page 12.
Well, we'll stay on this page, because I think we can explain
Which
it.
page is that?
So
This
just-
page 11, if you look at
Okay, we can stay on 11 for a minute.
the
then.
Russell 3000, which was in the policy index, that's representing the US equity on that.
Mhm.
So the Russell 3000 has become much more of a large cap dominated index. So it's about 85% not, or large cap, and about 15% non-large cap. If we look at the split between large and small, actually, you have more small cap than 15% of your US equity. So if you look at those subcategories, your US large cap on a year-to-date basis, actually, it's in line with the S&P or the Russell 1000, and your small cap is roughly in line with the Russell 2000. So what's happening is that because we have more small cap than what was represented in the Russell 3000. So we've refined the policy index a little bit to be more specific to large cap, small cap.
So you're saying Russell 1000 has become more large cap?
Russell
Russell
3000.
3000.
Okay.
So that's what's rolled up into our strategic policy index. Our whole US equity allocation is
Sure,
benchmarked by
Russell 3000 right here. Okay, yeah, sure. So then if we look at, let's say, page 12, and we look at Aristotle, which is the US large cap equity,
Value.
Large value.
large value, it says US large cap equity. So when they're comparing it to the Russell 1000, it shows 1 year underperformance is 6%, is that correct?
Yes, versus the value benchmark. Their value.
And then we go down to Jensen. Jensen would be our growth, correct?
Correct.
And that would be a 2.25% underperformance.
Yes, over the 1 year.
And then, so on Granite would be 6% underperformance.
Yeah, in the small cap, yeah.
Just wanted to make sure I was on that.
Yeah, so with active management, again, we'll kind of talk about this as we look at our international benchmarks. Obviously, we know to beat the benchmark, you got to be different than the benchmark. And sometimes that's in your favor, sometimes it's not. So, I mean, exactly as Sharik pointed out, the last year has been very hard for active management really across the board. Active managers, frankly, all indices have become more concentrated, and managers haven't owned as much as the largest names. So even in particular, the 1 year, which Sharik just pointed out for Aristotle, down, 6, it's up 7.5, but its benchmark was up 13. Similar with Jensen, up 15%, its benchmark was up 17. So underperformance for both of those two over the last 12 months. If you look at the last 36 months, a little bit of a different story, right? It trailed a lot in the previous last 12 months, but then the 24 months before that had to at least add some of that back to Jensen. You can see cumulatively over that time period is actually above, and then Aristotle much more in line.
So if I look at Jensen that you just mentioned and I take a 5-year number, is the underperformance about 4% per year?
Yes, 4% per year over the last 5.
Okay.
The 5 years before that, certainly better, as it brings that down to 1.3, and then, well, they've been in the portfolio for
Yep.
quite a bit of time, about 37 basis points. So, yeah, certainly the last, certainly 12 months has been a tough environment for active managers, like I said, not as concentrated as the benchmark, but also keeping in mind, again, just going back to page 11, and Jake highlighted the numbers. Some of that, particularly as it rolls up to the strategic policy, is a little bit just, by design, and for a lot of the reasons we've talked about in here, and also from the pulling back the payer benefit payments from where we think is most overvalued, not having as much large cap exposure as actually in our strategic policy has also been a drag on the overall relative performance, particularly over the last couple of years.
Oh, I thought we had the full allocation to large cap.
We're talking about.
Anyway, go on. I mean.
No, so again, it's not versus our target weights, but then when we benchmark it, historically, large and small, you add that combination together is benchmarked to the Russell 3000, which is, again, about 10-15% small cap, where have been about 25% small cap for US. So, I mean, again, kind of main points for what we just talked about, US equities. I do want to hit on, because we're about to switch to this. If you look further down on page 12, so Silchester, the manager in question that we'll talk about here in a few minutes, what you can see, again, kind of similar story year to date. You can see down about a little over 2.5%, 2.6 relative to its benchmark, still up 60.8%. We talked about how strong international has been, and we'll highlight this in a few minutes. Silchester, more of a defensive manager within international. We're not as surprised they've trailed. And you can see that over the last 6 months, down 2.6, but quite a bit less underperformance over the last year. So again, a little bit of short-term periods, quite a bit of volatility swings. And again, remember who Silchester is paired with. WCM on the other side, strong up year in international markets and really strong outperformance from WC.
The other thing that's really helped that had been a headwind for some time is the international small cap. If we look at that, it's really done well. For several years, we were looking at Blair and Mondrian, who Silchester not only replaced Sanderson, they replaced Mondrian in the portfolio, which was smaller cap value, because non-US small cap had not done well. You look on a 1-year basis, international small cap, the benchmark's up 18, your manager's up 20, almost 22. And Blair has a bit of a growth bias to it as well. And so that's been beneficial. And when we roll all of that up to your non-US composite, that's where you're seeing that outperformance of about 50 basis points on a 1-year basis. It's coming from what's complementing Silchester on the growth side today, both WCM and Blair.
And then last, just a few things in our performance, and we'll switch to our international discussion.
Let's stay on domestic. I'm going to go back to domestic for a moment. Our target allocation for large cap domestic is 24, and small and mid cap is 7. My phone is off. I have my laptop. What is the percentage there? What's the relative percentage? It's 31, and 7 out of 31 is what?
77-23. And so that's a little bit more reflective of what the non-large is today. So small and mid.
All right. My question is, and I recognize that the market has broadened out over the last 2 months, really. But it's still, the performance, and certainly in the S&P 500, it's still heavily concentrated in 10 names. I just looked at the numbers yesterday.
Right.
Yeah.
Very heavily concentrated. Have you given any thought as to whether or not we should reduce somewhat our small cap allocation in favor of large cap? Now, again, that goes back to what your asset class projections were as you presented them in the beginning of the year. Things have changed. Is there any reason to reconsider increasing the allocation to large cap equity, domestic equities, somewhat at the expense of small cap?
So I think as we look at this, in particular, so large cap continues to be very highly valued, right? High PE multiple is very kind of expensive, and this is something we've been saying for several years. We see more, going back to our capital market assumptions, as you talk about, more not attractive valuations, attractive go forward returns within small cap. Now, we want to be cognizant of how we are relative to the broad universe. And so at about 22% small and mid, that is now somewhat closer in line with the broad universe. I will say what is important, particularly, we have Earnest in our portfolio that really does add quite a bit on that mid portion, right? So small and mid. And so I think it's very important we continue to keep that SMID allocation within the portfolio and their ability to kind of move up in that cap structure.
But and also the active management that you have in large cap that Sharik pointed out has underperformed. It's underperformed because you don't own as much of the very largest names. So
I understand.
if things go a different way, market really broadens out. That's a
Although Jensen's portfolio, the names in the portfolio are very good names.
well,
They
and
just
so
haven't
those
kept up
Aristotle,
with
they just
the
don't
others.
own as much of what
Palantir
the
or
biggest
whatever.
names
Yeah.
in the S&P 500 are that have driven performance. So that's bringing market cap down a little bit, even within large cap. So, we don't tend to revisit strategic allocation every month. We spent 4 or 5 months on it at the beginning of this year and established that. We'll revisit it again beginning of next year, but we're not proposing a change to your strategic allocation. I think the one thing that we did do, just recognizing that the way you're actually have been allocated, that the policy benchmark that we're using is a bit of a mismatch. So adjusting the policy benchmark, it's not changing the allocation, but to more accurately reflect those specific pieces, using the S&P 500 to represent large cap and the Russell 2000 to represent small cap, that's going to limit the tracking error that you see on a month to month basis.
Yep.
Doesn't change the performance of those managers.
Yeah, and I'm not thinking, when I even raise a question, I'm not thinking about the next year, thinking about the next 5 years. It seems to me that the dynamics of technology at this particular point are such that it could continue to outperform dramatically over the next 5 years. But we'll see. And that might not be may not be fit what our original expectations were.
Right.
Okay, fine, let's go on.
Well, now it's going to hit on performance. I know we want to spend some time on international discussion. Are there anything else you want to point out, questions?
One quick question. I think we might have brought it up last month. Do we have anything pending on the private equity side? Are we going to make a second commitment to portfolio advisors? I can't remember what. I know they came in, and then I don't remember what we decided after that.
So our goal is in the next month or 2, 3 months to, yes, bring back private equity, most likely portfolio advisors,
Just make a-
but make another commitment. It's been a couple of years now. Is it 3 years since our last one? Again, kind of with the fund-to-fund approach we use with portfolio advisors. Now is about the time to add that.
Are they still in the market with the fund that's been talked about last year?
I believe so. It's usually an annual, they just give value annually.
So that fund that you made a $60 million commitment to in 2022, it's over 50% called. They've called,
2/3.
37 million.
And as I read your page 14, we've got the distributions back at $446,000.
It's still very early in that fund's life. We would expect those distributions to pick up. And so that market value of 40.1 million, it's marked up with some distributions. That's going to start to go down. And so that requires continuing making additional commitments to new funds going forward.
And the final observation, again, on page 13, our real estate, yes, we have it on our page 11, actually. Our real estate assets over the last 1 year period posted a 2.8% gain, but over a 3 year period, down 4.7%. And if you go back to our peer ranking against the peer group that you set up back in 2021, we ranked in the top quartile, matter of fact, the top quintile for 1, 3, and 5-year periods against our peer group. That was at the end of 2021. Whereas at the end of 2024, we're, matter of fact, several years in between, we're way down in the peer group. One of the reasons for that presumably is our relative allocation as well as performance to real estate. I don't know that for a fact.
It's a little bit higher allocation to real estate and relative to peers, a lower allocation to large cap US equity. And those peer groups, even I think we're using the 250 million to $1 billion, that is still dominated by the much smaller plans in that range, where they typically have a lot more US equity. As we look at plans over $1 billion, the median returns actually do come down. Not that, I mean,
Because
they have less, they have more private equity, more real estate, more hedge funds, more other things. And that hasn't worked as well. The other thing I'll say about real estate, the purpose for real estate in the overall asset allocation is to provide diversification from traditional stocks and bonds. It has a premium return to fixed income over time and less volatility than equities. If we look at on page 13, because you see the Reef and Heitman that you've had for over 10 years, their returns, Reef's return over 10 years through June is a little over 5%. Heitman's is 4.5%. Fixed income aggregate was up 1.76 over that time period. So you did get a premium return to bonds over that time period, and it was less volatile than equities. 2023 and 2024, following a 400 basis point increase in rates, we saw a huge resetting in valuations in real estate, and particularly in the office market. That's starting to bottom out, and you're starting to see valuations ticking up again. And the outlook, the forward-looking outlook for real estate is certainly more attractive than it was a couple of years ago.
I'm still just as negative. But I sit on the board of a publicly traded real estate investment trust. And I don't see the recovery in office real estate. Industrial, great. Biotechnology, office parks are great. Obviously, the
Data center.
Data center is great. Office, there's a cultural shift that has occurred as well as a financial shift that has occurred.
For sure. And you're seeing that in the underlying investments that you hold.
Yeah.
The office allocation has come down dramatically. And any new investments you're seeing, and that's what we look at PRISA 3, their returns more recently have done better. It's more of a core plus strategy, and they're in a lot of non-core sectors. Very little office, much more multifamily, industrial, data centers.
Yeah, broadly speaking, I think many more sectors, our managers, other managers we follow are getting into, with certainly away from office. So certainly it seems like a lot of positive activity, and certainly, I mean, more importantly, as Jake mentioned, just to add diversification to the portfolio areas away from traditional stocks and bonds.
All right, let's go on to the international large cap value question.
All right, so within international, again, why don't we just flip to page 18. All right, so we have Acadian within emerging markets, but on the developed side, on the left here, these are our 3 managers where we're invested. Silchester on the value side. Again, if you remember, we used to have Mondrian. We redeemed from Mondrian, which is small cap value, added to Silchester.
And Sanderson.
Right, Sanderson was pre-Silchester. And then, on the other side of kind of this growth with WCM, certainly the very kind of mega cap, large cap focus, and then William Blair on the small side. So there's been talk about with some of Silchester's performance. We hired them back in 23, I believe, to split Silchester and complement that with, if you remember going back to for those that were here when this happened, we had talked to Causeway, Columbia Threadneedle was another manager in the mix. And so kind of since then, we've talked about splitting Silchester and complementing that either with Causeway, who has been in here, talked to this group in the last few months, or a different manager.
I just want to give a little bit more color on that. So at the time, you had Sanderson, which was, they're more of an all cap strategy, but they tended to be more in the large and mid cap names. And you had Mondrian, which was a dedicated small cap value manager. Sanderson had struggled with performance. They actually had a significant loss in assets. Tim Sanderson, the founder and president, had left the firm. They were shutting down the firm. So the intention was to replace Sanderson. When we looked at the candidates that Finney mentioned, and had a long discussion around Silchester, Causeway, Columbia Threadneedle, the decision was, okay, well, we like both Silchester and Causeway. We're going to go with Silchester to replace Sanderson. But if we do that, because Silchester's strategy is, they would define it as all cap, but historically they've played more in the small to mid cap area. So we said, if we're going to do that, we should also get rid of Mondrian to reduce duplicity. And so that was the single candidate, and then complemented by what you see on the right side.
Although, Jason, I think even in absolute terms, Mondrian's small cap value was doing really poorly. And it was rather remarkable because they had just done so well over a prior 10-year period. And I got to know the people quite well, the manager of the fund and so on and so forth.
That helped with the decision, but that wasn't we weren't looking to get rid of Mondrian at that time, and we weren't replacing Mondrian directly. That was part of the discussion.
So, and initially we had talked about, Causeway, comparing what that would look like if we were to add them to the portfolio. So we had laid out before, you guys have seen this, page 19. So we've updated this through June 30th. But it's kind of looking at what the 135 through 20 would have been, so the benchmark, the EFA index is in purple on the right of each. We've shown Silchester's return in dark blue, Causeway in gold, and then a 50-50 split in green. So obviously the 50-50 split would be in between from a return standpoint, either all Silchester or all Causeway. You can see kind of across the board, Causeway is ahead of the index over each period. Silchester's behind the index of 1-3, but 5 and beyond ahead of the index. And a lot of it, I think, really kind of comes down to the next two pages, highlight some of these just differences between the two managers.
What 2 pages are you referring to?
The next page is page 20. So page 20, kind of same thing. This is for a calendar year though. And we've kind of put in order, rank the return of Causeways in gold. Again, a 50-50 split of the twos in green, so it's always in the middle, and then Silchester in dark blue. And so you can see what's driven a lot of this. These are the past 20 calendar years. Really the most recent two, 24 and 2023, pretty strong outperformance of Causeway relative to Silchester over this time period.
I'm a little confused. In the May meeting, we all decided that we're going to look at Causeway numbers were not that impressive, and we were going to look at some alternatives, both on the passive and active side. And I know you added a few names here with some data, but I think most of this work here is again done in combining Causeway with Silchester, several pages, and what those numbers look like. But I don't know if we are there yet without making a choice as to which manager before we dive into what the mix number looks like and how it plays out.
Yeah, so I'm just wanted to really, again, kind of remind the group what we talked about. I think, Sheree, to your point, we're going to hit on the next few pages. But, again, just a reminder.
We need to make the decision first on the manager before an active versus passive, before we look at mixed numbers. It doesn't make any sense while we're looking at the mixed numbers.
I guess there's some, we need to understand what you're asking for us. We brought a recommendation to you, and our recommendation was a single manager to complement WCM and William Blair, and we're comfortable with that. So we're responding to.
So you don't want us to look at other numbers, just go with this one?
We're comfortable with the current structure and we're bringing options back that you're requesting. So if they're specific, I don't know.
I think in the-
What we're showing you
last
here
time
is
that-
our short list of international value managers. So we broadened that out to include Artisan and Columbia Threadneedle. There are others. We could throw a whole bunch of strategies on the page for you and a whole bunch of passive strategies if this board wanted to vet through those.
Why don't you pick Artisan and Columbia Threadneedle?
We have what we call a reference list, which is a starting point. It's not an exclusive list. So I think Finney put
I
here
didn't say, I wasn't implying it, it
Uh,
was.
on page 22, this vetting process. So we have a dedicated team of research analysts that their job 20, 12 months a year, 7 days a week, they're by asset class, they're vetting managers. They're charged with having at all times a short list of managers that would be a starting point for particular clients. And that short list of managers per strategy. So for non-US value, we typically have 3 or 4 managers on that. There's a broader pipeline list of managers to be considered. So these 4 that we've included here are the current short list or reference list of managers that our research team and investment committee deem our best ideas at this point for particular clients. It's not an exclusive list of the best managers available. It's who we think would be good fit for our clients today. And we'd be comfortable with, we've done the due diligence, met with them multiple times, vetted the team, the performance, vetted the strategy, been on site with them as well. So if there's other strategies, oftentimes clients will say, well, I want to look at XYZ manager. We can throw XYZ manager in the mix or XYZ strategy. So we did a search, came to this board. Historically, you've asked us to bring our best ideas to you. We did that. You made a decision. Now we've come back. We said, well, we want to revisit, maybe have something else on the value side. We brought those back to you. If you want to open this up to include 4 managers or other strategies, that's your choice, the board's choice.
I was a person who said, I'm uncomfortable at this point, staying solely with Silchester, even though I have this historical high regard for Silchester. So I wanted to see the best partner for Silchester to split the large cap, international large cap value allocation between two firms, two vehicles, Silchester and X. And so that's how we got to Causeway, which was the other of the 2 vehicles we looked at in 2023, I think it was. And those were the 2 best we looked at that time. And that's why we were looking at Causeway. Now. Do you have any other thoughts?
No, I mean, I just don't get it. I thought in May meeting, we said we want to see some passive alternatives. And we also talked about, so that we can, but I don't see anything here in trying to make that decision. I mean, even Tony mentioned that, Causeway was not that impressive, I remember in the same meeting, and then we wanted to see some other choice. It wasn't just me, and I think the board generally. So I mean, come back and say we still recommend Causeway. Okay, I mean, if that's what the board wants to do, I mean, I guess we'll go with the vote on that. I mean, but I mean, that's not what I wanted.
Yeah, so maybe we can continue going through this. I think the first thing, so as we talk about passive.
I mean, we specifically talked about bringing numbers on several passive.
Right, and so we do have those,
I
I guess, Sharik, my point is, so passive, you're getting the purple bar from a return standpoint.
Where are you?
Page 19. That's what passive is, right? You can go buy the EFA index. And so that's what the return is minus the fee, which is on page 32. right? So these are kind of the options,
Where are we, page 32 now?
32.
And what are we doing here on 32?
Well, he's showing.
I'm showing you so you can get
Index
the
return.
passive, you're gonna get the passive return, and then we can pay basically 3 basis points for that. That's it. I guess I'm confused at what other numbers you want to analyze, but that's the return you get. Here are the fees. Now, what I think the numbers we should look at are does passive.
I mean, to be clear, I was hoping for a table where you would put like maybe 3 passive choices that's on your platform and 3 active choices that you recommend in addition to Causeway, that there are the other 2 choices. I understand you're saying Causeway is our top pick. That's great. But in order to compare it and look at that 10-year numbers, look at Sharpie ratios, look at up-down captures. I mean, we don't have any of that information to select a manager. If you're saying that all that information is on your end and we don't even need to look at it and just go with your choice, then I guess that's, I mean, that's how we do it, and that's how we do it.
So a couple of things. So all of what you said is in here. We keep kind of going down.
Okay.
Conversation keeps getting pulled a couple of different directions. But
Okay.
all of that is in here.
Okay,
So what do we want to go through first? Here, tell you what, why don't I show you that list of passive options is on here. It's page 32. Page, this is 28 through 31. But really, our recommendation is not to go passive in this case. Because we think, frankly, just the quick summary, and I go through all of this, but you throw a dart at the universe and you're much more likely, if you do no work, to find someone that's going to outperform over time than an index. That's what all of our data has shown. And then we do have other, what we care about first off is if we are going to add another manager, how does that complement what else is in the portfolio?
I'm sure.
Not just Silchester, but particularly WCM and William Blair. So we've kind of shown that on page 26. And then we do have that list of others besides Causeway. I wouldn't say Causeway is ACG's recommendation. But they are in the group that we really like, which is page 23. And we have all the Sharpe ratios, up, down, standard deviations on 24 and 25. So I can kind of take this in whichever way the group wants.
So on page 24, the Sharpe ratios for the index are going to be the Sharpe ratios for the passive strategies, plus or minus a basis point. Based on.
Okay, I'm on 24.
So we're looking at 24. So the EPA index, which again is what we would get if we were to invest passively, minus a few 3 basis points for fees. And then we have the 4 managers, Silchester's where we're currently in. 3 others that we've kind of included in this process before are on what we call ACG's reference list.
Mhm.
And we're showing columns 1, 3, 5, 10. What the return of the index up top, what the return is of the 4 managers below. If it's in red, it underperformed the index. If it's in black, it outperformed the index. The next was that 3 columns or 3, 5, and 10 standard deviation. The higher the standard deviation, the more volatile the manager is. And then, to the right is that Sharpe ratio, that measure of efficiency, which is, it's a little more complicated, but think about it as return divided by standard deviation. What bang for your buck are you getting?
And then page 25, you have up and down capture. There's no up and down capture for the index. And the index funds should not have an up and down. I mean, their up and down capture should be
100%.
right. Maybe a basis point or 2 off,
Mhm.
based on trading and other things.
Sure,
But that
cost.
So just one of the points just on Silchester, kind of as a reminder to the group why, a big reason why they were hired back in 23, and I think certainly is their profile, this up-down capture on 25, so it's the bottom half. So again, you read up-down capture on the left 3 columns, that's up, the right 3 are down. Up means if the index was up 100, what was the manager up?
So what are the couple of passive choices that you have here?
So is on, you have the page
32.
32. Northern Trust, Vanguard, Fidelity, and SSGA.
And some of those are ETFs, which you'd need a brokerage account. You don't currently have a brokerage account. So that would be something that you have to get set up.
You know,
How is, why is it that Rumsfeld is a passive strategy that we have?
It's a commingled fund.
So you don't have a commingled alternative on the?
No, some of these are.
No, we do. Just State Street is on here, but that's an ETF, so it's a lower fee. But unless we had a brokerage account, we couldn't do it. The other three have mutual fund options that we'd be able to do.
I'm sorry, you
no,
went.
you have to repeat that.
Yeah, so there's only one that is not applicable here that would need a brokerage account, just like Rumsfeld. Which are the alternatives that we have on your platform
But
currently?
we don't have a platform, but you custody at Northern Trust. And so
Northern Trust platform. So what can be held there?
Mutual funds, commingled funds, separate accounts.
I understand, which is the one in this thing that cannot be held that you said.
So the first row is vehicle. So if you look, so State Street all the way on the right, they only have an ETF. So again, we could do it if we set up a brokerage account. That kind of seems like a lot of work, and that was something.
But they only have an ETF. They don't have a commingled trust
For this, for developed international.
value.
These are all core EFA mandates.
Why are we looking at core when we really just want to enhance our value? Our value opportunity, international value.
Well, because,
Trying to enhance our core.
so somewhere with, just within international for both WCM as well as Silchester, we've benchmarked them historically versus a core benchmark. And so
the combination.
the common,
We could look at value out, just value. Well.
No, I'm confused. What I asked you to look at was international large cap value.
Which of those
Active
active
managers, and I presume you were going to look at passive vehicles for international large cap value. You're telling me these are not passive vehicles, or these are not
These are passive.
value vehicles, these are core.
no, yes, correct. These are passive core oriented vehicles.
And so I'm asking, why would we look at core when we're trying to enhance, in my opinion, my objective, put it like that, to enhance our performance and opportunity in large cap value. I'm happy with large cap growth.
We're looking at the whole, and so the
Yeah.
objective is to outperform the non-US market. Now, if we look at value, if we put the value benchmark on here, it's gonna look worse over this recent period, which is fine. We'll do whatever you want.
Yeah, and no, I
We're
think,
responding to what you're asking for. I think maybe it's been a little bit unclear because there's multiple
yeah,
requests.
and part of that was our understanding was we were going down potentially splitting Silchester with another active value oriented manager or going more passive within our international.
That was not, I know that was not what I thought I said. But maybe that is how it was interpreted. I don't want to mess with WCM. I don't want to mess with Silchester. I want more power in the international large cap value arena, whether active or passive. You have convinced me that international large cap is we should usually look at active rather than passive because there are many more opportunities to outperform in international large cap.
Right, and that's what the active passive
everything.
analysis here.
So I was just looking for, what are the alternatives for managers, which you've already.
And that's what we've shown.
And what are the active managers and what are the alternatives for passive?
And so that's the active passive analysis that's in here on 28, 29, 30, and 31. 31 is probably the simplest way to look at this. Develop non-US value 70% of the time, 70% of the managers are outperforming the benchmark. immediate
And the
manager.
work you provide in January or have provided on several different occasions. uh, uh, Make it clear, but that opportunity to use active management and international large cap
It's
is
robust.
it's very robust. So I'm asking, does Vanguard have a international large cap value passive vehicle? Does Fidelity just State Street? And if the answer is no, they just do core. Oh, I just want to know why we're looking at this.
So we can get back, these are all core options. We can see if they all have a value. What I would say is broadly speaking,
This
it's
is,
less.
this is what Sharif wanted earlier, I think, was a core, a passive vehicle option as well as an active option for international large cap value. As I interpreted Sharif's, maybe I'm misinterpreting this.
You know, I mean, we are all trying to serve the same objective here, I think. So I think one concern that's been talked about that I've voiced for over a year now, probably since I've been here, is the weakness in the dollar that we are finally, that would happen, that is finally starting to play out, that you are saying when you're touting the performance on some of these international funds, that's mainly currency related. And then the question now is, where do we go from here? In my opinion, who knows? But in my opinion, I think that that weakness will only continue. I think we've seen President Trump say that with the new Treasury chief, they're going to lower the rates. Lowering of the rates will cause funds to leave here and further weakness and the dollar to weaken. It's almost a given, in my opinion. So I think there are some things you can do with low confidence and some things with high confidence. In my opinion, it's pretty much high confidence that the dollar continues to weaken. Number two, if I look at I understand we've all lived in the world of active management and choosing active managers and trying to beat the index. But if I look at all our active managers, they have all underperformed their index. And we have reasons and whatever, that's fine. But I think we are weak here a little bit on passive investment. So my 2 cents were international makes sense, passive makes sense to me at this point. If it makes sense to the rest of the people, then we look at options. If it doesn't, then we move on. I think we are we've talked about this ad nauseum, and I don't know if we are making progress. And at some point, it becomes frustrating. I thought those questions were fairly simple, and the answers were fairly simple. But for some reason, this is becoming very hard, and I don't know whether I should just back off from the whole thing, because it's to me it's very simple, but for some reason we're not.
So do you
making
just want
progress on
EFI
this.
value options?
If it makes sense, I mean, this is a team. I mean, everybody said, Tony Mills. I mean, everybody would chime in and maybe make a decision and move on. I mean, we can't go round and round on this. That's all I know.
And what would be the criteria for selection for EFI value index options?
I mean,
Presume it's
I'm looking at
fees.
every active manager here, right?
But
So, I mean,
from comparing different index options, I mean, it's fees and the size of the fund.
yeah, absolutely.
Is there anything
I mean,
else that-
fee is a big thing, yes. I mean,
Okay.
you can do most of this thing at 5 bips or 10 bips. Yeah, I mean, I would say so. I mean, please.
I mean, I think we're going down a rabbit hole, but I think the one thing that actually would help maybe the board is we've got a current international mix today. That mix is not in line with the policy, the updated policy benchmark. So we have to make some shifts to get from where we are today in line with the new policy. So first of all, just yes or no?
The overall fund?
Yeah, so we're
Just-
currently,
just the
we
international
increased our allocation to international, so we're about
About 40.
3% underweight. A lot of that really matches up with our real estate allocation, which some people come from, but then I think, you don't think so?
It's all right. I see it a little differently, but that's all right.
Um,
But just yes or no, where we are today is not in line with the policy, right? Even it's in, we're not violating the policy, we're not
no.
at target.
I mean, you're almost 3% overweight EM and you're
Yeah,
3.5%
Hold that thought.
underweight
That's exactly where I was going.
developed. So
So we have to make some changes to get in line with targets. I think it might be helpful for the board to almost see a page that says, here's where you are today. Here's what we would recommend to be in line with targets. And what I'm thinking is when you add roughly that 40, I'm rounding, $40 million has to be added to international. Where does that $40 million go? And I think one of the concerns is we've already got a 9% position with Silchester. We've got a 10% position with WCM, 7% with Artisan. Those are big allocations to managers. Does it make sense with an increase, more money going to international to add at least one more line item to create some diversification in the international mix? And I think that's how maybe that helps. This is more of a structural question with more capital going into that. Do we just allocate it to the current manager mix, or do we add something to create some diversification?
You mentioned Artisan, Acadian.
I'm sorry, Acadian, sorry, the emerging market manager. Which has to be trimmed by roughly third to get, just remember, roughly, that has to be trimmed about $30 million, and that's where it could go in.
Right now, you're about, in developed, you're 12% growth and 9%
Right.
value.
Right. And I would argue 9 and 10% allocations to managers, that's pretty large, and we actually have to add to that. So, I would almost view this more of adding a manager is simply to help reduce manager-specific risk in a portfolio more than anything. So does that help? Does that?
It does, and I guess
Still the managers were showing, and if you wanted to see value index funds, we can show you that, but they're going to be the return of the value.
Maybe I'll just give you all a little bit of white space here to say, what would your recommendation be to get the portfolio just specific to the international allocation in line with the policy benchmarks? What would your recommendation be? And leave it open to you of saying, is it adding a manager, is it adding an index? But there has to be money movement. We can't stay where we are. So what is ACG's recommendation of what that new international composite should look like? And I'm including emerging market.
We're not uncomfortable with the existing manager structure.
Well,
We would not
but
be
it's not in
opposed-
line with the targets.
So I think it
But
would be-
rebalancing with the existing managers.
Right, so taking 3% from Acadian and giving it to Silchester.
The allocation isn't in line with the target.
But
They were talking managers versus allocation. I think you're saying the allocation is in line with the target. They're comfortable with using the existing managers and increasing the amount of money or decreasing it to fit the allocation.
I understand.
I'm uncomfortable with one specific item, and that is Sanderson by itself. Or Silchester, I'm sorry, Sanderson's long.
So in response to
Silchester by
that,
itself.
we would not be opposed to adding another strategy
Right.
on the value side to get the value up in line with growth. Our data and our opinion is that an active strategy would be what we would recommend. If the board collectively says, no, we don't want that, we want a passive EFI value strategy or acquiesce US value, well, we should find the cheapest one because the performance is all going to be the same. That is as the largest and most liquid.
But just to keep it simple, just trying to think of easy. Here's where we are today. Where we need to be, option A and B. Option A is where we need to be with the addition of a new active manager. And option B is here's where we need to be with a index option there. And just look at those two portfolios. And I would say,
That would be the same. The allocation would be the same.
well, but
The manager lineup would be different. The allocation would be exactly the same.
we have to add capital to.
No, I'm saying,
Yeah.
we have to rebalance the whole international,
Correct.
because we're reducing domestic. We have to rebalance international as well as domestic.
Right.
So let's take the asset allocation, which is already the asset allocation target, which we've already approved.
Right.
That's a given.
Yep.
So it's only a matter, in my mind, whether or not we split the large cap
Right.
international
Yep.
between Silchester and Causeway, or Silchester and a passive vehicle. Now, if we talk about Silchester versus a passive vehicle or Causeway versus a passive vehicle, we can look at their performance against passive vehicle, against their underlying index anyway and come out and decide whether or not it's worthwhile
Yeah.
or in our best interest to have a passive vehicle. I don't think it is. I think active management in this particular asset class internationally is probably the best way to go. But it does introduce additional active manager risk as opposed to passive. But I'm willing to take that because as I understand it, the opportunity for active management in international large cap value, international large cap growth is worth taking that active manager risk. That's how I see it. And that's why I'm only disappointed that you didn't simply provide the international large cap value vehicle. And that's what I'd ask for. I wouldn't select it, but I'm disappointed you didn't provide it. That's all.
Index
And I think
options.
we need to see a little bit of almost like a pro forma too, of what is the international composite? What would it look like if we were to be in line with targets?
Yeah, I mean,
And also, I have a little bit of a hesitation of having manager line items that are more than 10% of the portfolio. And that's what Silchester would be if we kept the current lineup and just added capital.
And we're good with WCM at 10%?
No, I think that's too high too, but that is just a matter of opinion, but that's a lot of manager specific.
Where are we on WCM right now?
10%.
And Silchester's basically 900.
That is not anything that we have specifically talked about before, but I think that is reasonable. I think that's a reasonable approach. Let's cap that allocation at 10%. Now, I don't know what we're going to do on the values on the growth side, but just cap that allocation at 10% for a given active manager. That seems to make sense. And maybe in that particular case, if that's all I don't know how much more would go into growth, international large cap growth.
Well, none, because you're underweight value right now. If you look at WCM and Blair together, that's 13%. And Silchester is 9%. So we're at 22%. And we need to get to 26, but emerging markets is overweight. So really what we're talking about is taking money from Acadian
Right.
and allocating it. It's not coming from US equity or fixed income or real estate
That's
necessarily.
why I was
Yeah,
arguing.
it's just coming from emerging markets and it needs to go to the value side.
Right.
So
Reiterating, we're not uncomfortable with being over 10%, with it just being Silchester, but if we were gonna add, if we don't want that to have managers over 10%, our preference would be an active manager.
I understand.
And here we've provided our short list of candidates. We can go back out and look at others. If the board's desire is to have a EFI value or an ACWI ex-US value index option instead of an active option, we can show that. You can pick that.
I don't know. I agree with Sharik. I don't know why this is complicated. Where we are today is not in line with targets and we have to make changes. Can we see a couple of options of what the new international allocation would look like with the addition of the capital that's needed and the shifting of emerging market to the developed side to be in line with targets?
Yeah, so certainly, but I think what would help us is what did you keep saying, what does that look like, right? So our,
You want to see
But-
just
but, I mean, you
historical
just-
performance? of
yeah,
that?
like is it historical
Or do you-
performance? Is it like, what is it?
What would you normally do with a client that says, hey, we have to make changes in the portfolio to comply with our updated targets?
We'd make a recommendation that you move your money into Silchester and we're comfortable with the 10%. If you don't like that,
Okay, well, you show that to us, honestly. What does the new portfolio look like?
well, that's what we would like is to move that money into Silchester. And I think that's what's been communicated, but if you want to split Silchester, and it's been kind of, Causeway's been the one that's been pushed, this is what the returns in that section would look like. We've compared that to what it would be with just Silchester. We've shown that what the whole international portfolio would be if you split it or just kept Silchester.
I'm losing your point because we talked about the allocation itself. We looked at it previously.
Right.
So we know what the allocation is going to be.
Right.
So it's only a matter of.
I just wanted to say, here's where we are today. Here's where we.
So like
need
a
to be.
rebalancing
The actual
spreadsheet?
dollar
Yeah.
amounts committed to each of those managers. Well, we don't have that here right now.
Hmm.
That's all. I just, there,
I don't know why that's critical.
I think it would,
What's critical is that I think your suggestion of capping an active manager at 10% is right. But that simply means we either do or do not have to do something on the international large cap road.
Right.
And on an international large cap value, you would do either Silchester and passive or Silchester and active. And Silchester active, to me, is Causeway.
Well,
But I don't see the complexity in that. The growing issue is whether or not we're gonna use Causeway or some other active.
Dollar
manager or
amounts,
passive manager.
yeah, the dog.
35.6 million more
Right.
to get, based on June 30 values,
Right.
it's gonna be different today and tomorrow, but 35 million more
Right.
would need to go into the combination of whatever managers are non-US outside of EM.
Right.
So you would take 35 million from EM, actually, it's not, because you're not that much overweight. It's probably 25 million out of EM and then 10 million from somewhere else. That is real estate more than likely because
Yeah.
you're,
It's gonna take a while perhaps to get there. I always thought so, because going back to our previous discussions, we were reducing real estate 5 percentage points. And we were actually increasing international allocation by about the same amount. And so it's gonna take some time to get there. But to me, I'm willing to press on. And you tell me if you're not.
would it be helpful if we sent,
With the asset allocation we've already agreed upon. And a manager to complement Silchester and let them go ahead and just move the dollars. I don't necessarily need to review the dollars any more than we review them.
would it be helpful if we supplemented these quantitative pages with index fund data as well? Not just the index, but like put the EFI value index strategies, what their performance is? Because they're gonna be below these numbers.
They'll be below core.
Well, and they'll be below the value in most cases.
Excuse me, repeat what you.
They'll be below the active value managers in most periods. The index.
Well, to complete the analysis, I think we ought to do that, and that's a pretty quick thing to do. I'm just surprised we didn't do it in the first place. Again, I'm not in favor of a value allocation here,
An index.
an index allocation. But to complete the analysis, and that's something can be done in a half an hour. Complete the analysis, let's do so. So let's assume that can be done. The real question is, do we want to do active or passive?
I mean, my vote's for passive. I mean, we're looking at three alternatives here that are about 3 bits and change. You're talking about paying 0.5% or more for active management. And so far, the history on this portfolio overwhelmingly has not provided value with active management. We are underperforming by 6%, 5%, 4%, and we are paying 0.5% more or more, 7.75, 75 bits more. And our best performer is Rumsfeld, which is passive. I'm not convinced, but I'll go along with whatever you guys do. If you're strong feelings on active management to roll the dice, and I have to go along with that.
Well, I
mean,
just,
that's it.
I don't want to be argumentative, Sharik, but I do just want to point out, if you go to pages 12 and 13 of the material, the active managers since inception, Aristotle has underperformed by 66 basis points. If you go to the far right of the page on page 12, Rumline, not Rumsfeld, Rumline, your passive strategies, which we believe is appropriate in large cap, has underperformed by their feet since inception.
Yeah, sure.
Jennison, over
So,
a 30-year period, has outperformed since inception. Ernest has outperformed by 4.5% since inception. Granite is about even, 12 basis points.
Okay, I mean, but what's the highest performance on this whole page? It's 16.59 on a 5-year on Rumsfeld, isn't it?
Yeah, that's it.
Because
That's
it's
an
a large
allocation
cap.
to us large case.
Sure, but I'm just saying.
I'm just saying the active management your active managers have outperformed. WCM since inception has outperformed by 300 basis points. William Blair by
One second,
90.
WCM 5-year number 0.98. We don't have a 10-year number.
The since inception, so that's since
Far
they've all
right.
been in place, the far right. So it's a different time period for every manager since they've been in the portfolio, what their excess return is net of their.
Sure,
management.
but if you look at 5-year number, William Blair, they've underperformed by 5%.
I mean, yeah, it
Right.
goes back to active management. They're gonna be different than the benchmark. Sometimes they're gonna outperform, sometimes underperform.
Sure,
Period, but
I'm just concerned about picking a manager because of, we all know this, because the performance, they look good on the numbers, but rather than the, the reason rather than data mining.
But if we had Causeway in the portfolio already, the numbers would be very attractive for us.
We
But
can go-
you're saying you can't,
We can go back and
can't-
we can go
can't
back and
believe-
select managers that have performed extremely well and choose them on that basis and say that if they had been in there.
Oh, and that's what people do, actually. You have any other thoughts? Well, what I want to do, and I'd like to bring this to a conclusion if we can, and we may not be able to. I'd like to make a motion that we do continue with our active allocation in international large cap, which is what we've done in the past, which has been largely successful. The analysis certainly says, the analysis that you have provided us on several occasions over the years certainly argues for active manager to pursue the opportunities in international large cap far more strongly than active management to pursue the opportunities in domestic large cap. In other words, it's a more fertile hunting ground. So I strongly recommend that we continue with that active allocation in international large cap. I also recommend that we add Causeway to the international large cap value allocation. Split that allocation 50-50 between Causeway and Silchester, which would keep us certainly under 10% for either one of them. Yeah. And that's what I would like to do. And unless you have I'd just like to make a motion so we can see if there's support for that. And if there isn't, that's fine. Everybody gets a vote. And if there isn't support for it, then we'll have to go back to pursue another alternative that everybody can agree with.
So you're making a formal motion?
Yes, I can repeat it if you would like. If it's not clear.
No, you don't. You sort of have two elements to that.
Active management, international large cap, split the international large cap equally between international large cap value, equally between
Causeway and
Causeway and
So
Silchester.
both of those in one motion. I would second.
Those are actually two separate motions, but those are two separate motions, really. But we'll make it one for ease of voting. Vote once rather than twice.
Thanks.
Unlike Chicago, you tend to vote twice, even if you're only entitled once.
Early and often.
Early and often. That's what Mayor Daley would say. Okay, do I have a second so we can at least vote on the issue?
Second.
All those in favor of pursuing that particular strategy at this point? Please say aye. Raise your hand.
Aye.
So we only have two.
No, Jody.
Oh, Jody, I'm sorry.
Sharon's with the scene.
She's still on.
Yeah, she's on. Jody, I'm taking you off mute. Jody, can you,
Yeah, I'm here.
okay,
Oh, there you are.
Would you like to?
Jody, did you hear everything we said though? However, I want to make certain of that.
I did.
Okay, good. And what direction would you like to go, Jody?
I'm
I-
going to vote yes.
Okay, fine. So that's 3. It's 3 and 3 then. 3 yes, 3 no's. And because Pepe's out. So we're at an impasse on that particular point. Would anyone, I'll accept the impasse. Now, would anyone like to make an alternative motion that might help us move past the impasse?
I mean, I
I
would,
need a specific motion though.
I would say current allocation to passive at this point is somewhere around 17, 18. I'm taking 131 million Rumsline has out of 900. So the exact math would be 131 over 900.
You're looking at the entire portfolio.
Yes, I am.
Okay.
14%, 15, let's say 15% in passive. So my point is to put another 3% in passive, you'd be still way under 20%, 3 or 4. Just going with that logic, I would say it makes more sense in trying to, 50 basis points on costs, 70 basis points, whatever the difference is, it's significant. My motion would be to choose a manager within those lines, within the value, within the international, only do a passive strategy in order to contain costs. And we have, in my opinion, no data showing that active would be of benefit to us. Historically speaking. That means, so my motion would be to go do the same thing. We are allocating within the same parameter, just on active passive.
Just not Causeway, rather presumably the lowest cost international large cap.
That's available here without too much headache of opening other accounts and stuff, and we have a couple of choices, then they're both 3 bits. So that makes sense to me.
Okay, well, can I have a second up to the motion? I'll second the motion. Therefore, let's have a vote. All those in favor, the motion essentially is, Jody, again, I hope you can hear us. That we do have a companion for Silchester. We split the large cap value international allocation equally between Silchester and the optimum passive vehicle.
The strategy remains the same. Yeah.
The optimum passive vehicle instead of Causeway. That's what it is. And I just second Sharif's motion. Are we ready to vote on the motion? All those in favor, raise your hand, say aye.
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 Okay, that's 4 and 2. Motion is passed. Now, would you please communicate back to us what the international passive vehicle should be? We've already approved it. We just want to know now what specifically it actually is. And I think quite possibly we need I'm not sure what the legal rules are, if we actually have to specify the manager in the motion.
That would be my recommendation.
Okay, what I would like for you to do, we're not gonna wait till the next meeting to do this. You gotta get life underway. So what I'd like for you to do, come back to us by email. We have to set up, we'll set up a meeting by phone. This is a county, this isn't a foundation. We'll set up a meeting by phone or video. You tell us the manager, the vehicle, we'll vote on the vehicle, we'll vote positively, and then there will be a record, and the meeting will be open, obviously, to the public if you want to listen in. That's why I said we have to actually have a meeting rather than just do it by email. Is that clear to everybody now?
Yeah, I think so. Just a quick virtual meeting for that vote.
Just to approve the actual passive vehicle immediately.
Yes, we could get that pretty quickly. And you want the benchmark to be the EFI value benchmark.
EFI value benchmark, yes.
Mr. Chairman, can I make a request on that though too? What are the dollar amounts that we're talking here as well?
Fine, you can do the dollar amounts based on June 30th numbers.
At
Recognize
50-50.
that it's.
It's at
50-50
Yeah.
between,
You want the total dollar amount.
no, if we just take 50% from Chilchester and put it in the passive index, is that what you're saying?
No, we have to increase the right cap value allocation.
That's my
Right.
point, yeah.
Yes.
And I think we need to know those numbers.
well,
But I think also if we're gonna reduce Silchester, I think we have redemption costs too, and I think the board should know what those costs would be.
right, 50 basis points.
If you could tell us the dollar amounts for that cost, that would be helpful.
So we're really talking about splitting 13% of the total portfolio. Because international developed target is 26. So it's
The target is what, I'm sorry,
26%.
26%.
So WCM and Blair are effectively half of that on the growth side. And the other half would be this passive vehicle and
You can-
Silchester.
What is the international large cap, the new international large cap value allocation?
It's 13%.
Okay, fine. So that's going to be 6.5, or 7 and 6. All right, and you'll mock up the numbers based on June 30th numbers.
And I think it would be helpful for the board to know where are those additional funds gonna come from? And I think it's the most emerging market for now. And even if it's real estate later, but what gets redeemed today to support that increase in capital? And I don't think that's an unreasonable request.
Fine, it would happen in.
So to add to Tony's thing, what you're saying is when you move money out of Silchester, there is a fee, redemption fee. That was going to apply if we moved it to Causeway 2, is that correct? Okay, so that's that. And is there a way to ease into it and minimize the fee or something, or there's no such thing?
Well, you ease into it by not doing it all at once and not necessarily using Silchester.
Like when you rebalance, those fees apply?
When you pull money out, yes, there's a fee.
So whenever you're taking money out on a constant basis from, like, let's say, large cap growth that had done well, and we're pulling money.
No, not on the US side. This is typically
Only on the international.
provision in international funds,
Commingled vehicles.
commingled
You
funds,
basically pay your trading costs of the vehicle in and out.
so that it doesn't impact other investors. But if it's dependent, we may be able to talk to them and do it in small amounts
That's be fine. with me.
over a period of time where there may not be a redemption fee.
That'll be fine.
The
with me.
provisions of the vehicle of the operating agreement provide that they will charge a 50%.
No,
redemption.
you guys,
50 basis points.
50 basis points, yeah. Not 50.
that's pretty steep. So I mean, if there is a way, please tell us. how
So
to-
you would phase it to minimize not the exit fee is what you're
If
saying.
Silchester can match up contributions into the fund when we come out, then they can waive some of that.
Let's just say we want to do this within 90 days. We don't want to stretch us out.
However long it takes to navigate through the inner workings of.
I would say 90 days.
When are you looking to have this vote?
I'm sorry?
When are you looking to have this virtual meeting to vote on
The
this?
only thing holding back is their conversation with Silchester as a how.
Well, no, and then we need to come up with the value index options. And I'm guessing we're gonna go to.
No, I presume you can do that pretty
Right,
quickly.
we can't.
But what constitutes quickly, this week or?
Oh, we can have the options because it's like, it's Northern Trust, it's State Street, it's Vanguard. I mean, those are the,
That's right. They'll have that in half an hour. What has to take place is the telephone discussion with Silchester, saying what we want to do. And that we'd like to do it in the most efficient and least disruptive manner to both parties.
Just FYI, I'm out of the office 28th to the 31st, next Monday.
We'll make sure. I presume you can have that conversation with Silchester with me.
Yeah, but we're not gonna know when we're able to fund it. I mean, if we're telling them, you know, it's gonna be in 3 months or 4 months, they're not necessarily gonna know what cash flows they have coming in. But we can talk to them, if you can match cash flows coming into the fund. And we,
And
While we're doing all this, are we gonna redeem Acadian as well and get that back to the 5% target? Is that part of this whole?
Yes, that will be, I think we'll have to get the new strategy approved. And then I don't know that process through county council and what everything that needs to take from the legal review, but once that's,
The only thing the county council has to be involved in is approval of a new manager. And the new manager, even if it's passive. The county council does not get involved in manager decisions other than that.
correct, just improving that it's going and we can fund it.
County council doesn't get involved in it. Doesn't get involved in moving money around.
no, not in the moving.
Not moving, but in the
Don't
new
move the money
index
until
fund.
the agreements are done, until the new manager is set up. And that historically,
Yeah,
that takes some time.
yeah, that does. That does. It would take time if it were Causeway or anybody else. It shouldn't take time, but it almost always takes time through the legal department, and the county council has to approve it even on a perfunctory basis.
I think that there's an
So
ordinance passed.
that's gonna be a month.
And then once the ordinance is passed, it goes to the county executive and administrative, and it goes around to multiple people.
And in this particular case, since it's gonna be a passive vehicle, I doubt that anybody in the council would even have a question. And if it seems to be, I can help move things along with the call to the county executive.
so there are subtle differences between the passive options in terms of what we are tracking from what you said here. Is one that would map closer to Causeway than the other options?
Well,
The EFA value would be closer to what we're looking for. Some of like Vanguard didn't have an EFA index. They used the FTSE, which is slightly different, but relatively the same.
So Vanguard would not map closer.
well, we're gonna,
We need to consider the value.
EFI value index is the index you want to benchmark to. That's what I'm
Exactly.
Okay.
saying. So we will go to the large index fund providers and say, we want an EFI value index. What is the fees on that? What is the amount of dollars you have in that? What's the liquidity on that?
Which I would presume each one of these people probably has a value index as well as a growth index and then the core index. I would imagine we can get.
But there will be different vehicle options as well. We'll want to, because there could be a commingled fund, there could be a collective State Street may have a CIT, a collective investment trust, or there could be mutual funds. So
How does the collective investment trust differ from commingled?
it's only for qualified plan assets. And so
Qualified plan being defined as what in this particular case?
retirement assets. Sometimes the fees are lower on that type of vehicle.
Hmm. Okay. Fine, would you get back to me directly on that once you think you've identified the vehicle, and then you and I can, I'll have a direct discussion with you, and then we'll bring it back to the entire board. Or our telephone, our video or video conference. Anything else?
I have more questions, no, don't get mad at me, but does the
No.
Acadian has redemption fees as well? And would we have to have the same conversation with Acadian that we would with Silchester about whether or not they can match inflows?
Yeah, we can reach out and ask them, but yeah, they'll be the same. Redemption fees associated with paying your way out of the vehicle, so we can talk to them. Trying to again line that up as well.
And that's inevitable in any event. Even if we're using Silchester, it's inevitable. It comes with rebalancing. Sometimes the portfolio rebalances itself just because other things tend to grow.
And if you had a separate account,
Sometimes you have.
you would be incurring those costs yourself.
I was just asking.
That's why.
That's all.
Anything further on this? We've made a decision. decisions are often messier than they should be, but they're often messy nevertheless. We made a decision. Anything else on this subject? Anything else you guys want to present or discuss?
So for us today.
Okay, any new business that's not already reflected on the agenda? Any old business not reflected on the agenda? Is Paul still on? Paul, under new business, are we now on target for the August meeting to review the actuarial report?
Milt, can you hear me?
We can hear you now, yes.
Okay, thank you. I do have all the data that I need. I'm working to get one more piece for clarity from county staff, but I have what I need. I have no concerns that we will be able to present the evaluation report at the August meeting.
That's terrific. Okay, other new business is the ordinance. And we are striving to have the ordinance for discussion and closed session back from the general counsel's office, hopefully a short closed session at the August meeting, right?
That's the goal.
That's the goal. And then we'll have it for the public meeting in September. And therefore, we should be able to get it hopefully to the county executive's office for review, comment, whatever, by October the 1st at least. Okay. Anything else?
So we have nothing else on the agenda today, right?
Nothing else in general today.
Um, Do you want to move to closed session and talk about any other issues that since we have time or not? No, you
No,
don't want to do
we
that.
really don't.
It has to be on the agenda.
Okay.
The closed session.
And we left the possibility of a closed session off the agenda.
It is not on the agenda.
It's not on the agenda, but also I've got some other pressing family things I have to attend to. Should not be
Absolutely.
limited on time. As I said before, we all
No issue.
talk it in the August meeting.
No issues.
All right, anything further? Before we move for adjournment? Visitors come in, anything further from the board? Okay, comments from visitors? Joyce?
Hi, I just have a few.
Sure.
And financial things are not my issue, but just about the ordinance. And I guess what I would really ask for is that it does say that there's a yearly review of the ordinance, and then to make a determination whether or not you're going to go full or not, and then just document that. And then also maybe looking at the consumer price index and what the inflation is on each year as to whether or not one is granted, which is very much in line with all of the other public pensions in the state of Missouri. I did a large study of those several years ago.
I know.
And with the actuary just kind of throwing out, or this many years retired or that many years retired, and come up with an amount, I don't recall there ever being anything that it's related to. And if we go by the rate of inflation, we may look at it and we'll start, and then everybody would get 0 or 1% or 2%. We're never going to catch up with the way it's been. And I know I've been retired since 2018. I've never gotten a COLA, but I'm okay with everybody being on board, whatever the rate of inflation is.
Mhm.
I mean, I didn't get a raise from the county 10 years before I retired. So it's been difficult, but this will be an easy way to put everybody on the same bench, rather than 4% for this many years. And at least do it yearly and document. You don't always have to give it, but you can at least make a statement. Thank you.
Okay, Joyce, thank you. Any other visitor comments from those online?
Only have to-
What, Anthony?
we only have to- until.
Okay, fine, well, Kevin doesn't deserve a comment. All righty, then I'd like to make a motion that would somebody make a motion that we adjourn the meeting? So moved.
Second.
Sariq gets second honors here. I think that's called gold, silver. Sariq gets the silver. All righty, thank you very much all.
Thank you.
Like,